Stop scrolling for a second because what happened overnight in the currency markets, the bond markets, the gold market, and inside the Federal Reserve's own internal logic is the kind of collision that looks like noise on a screen right up until the day you realize it was a signal. We just watched the dollar do something strange. Gold did something that made no sense on the surface. The Fed got pushed into a corner it has been desperately trying to avoid. And the global stock market just printed numbers that haven't been seen since the worst stretch of the Russia-Ukraine energy shock. And right as all of that was unfolding, the people running the show told you everything is basically fine. If you're watching your savings, tracking your mortgage, trying to figure out whether your job is safe, or just trying to understand why every single financial instrument seems to be sending a different signal at the same time, this is the video you needed today, because I'm going to walk you through what the dollar's sudden stall actually tells us about how traders are really pricing this war, why gold dropped when it should have surged, and what that reveals about the hidden mechanics most. People never see why the Federal Reserve is now trapped between two nightmares, and how that trap affects your mortgage, your groceries, and your paycheck. What the bond market just screamed with its biggest weekly yield jump since April 2025. And what I'm watching this week that could either confirm the stagflation scenario everyone is whispering about, or give the market one last breath of relief. And then near the end, I'll explain why the labor market data that just dropped is way more dangerous than the headlines suggest, and how it connects to every single thing the Iran war just broke. Now before we jump in, quick favor. My channel stats are loud and clear. A huge chunk of you who watch these videos regularly still haven't subscribed. And look, I get it. You can watch without subscribing. But if you're getting even a little value from this breakdown, help me out by hitting subscribe. We're building something real here at Market Acme, and your click genuinely matters more than you think. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build deep dive economic updates only for our special members, the Market Acme family. If you want to click the join button right now or use the link in the description. Alright, let's get into it. Tuesday's session wasn't just a market move. It was a confession. The dollar, which had been ripping higher as traders piled into the one currency backed by a country that actually produces its own oil, suddenly stalled. Dropped 0.3% to a one-week low. And on the surface, the reason was simple. Trump said the war could end sooner than expected. Markets exhaled. Equities ticked up. Oil pulled back from its 3-year highs. And for about 12 hours, the world pretended everything was going to be okay. But here's the part most people miss. At the exact same time the dollar was weakening on hope, Iran's Revolutionary Guards called Trump's remarks nonsense and said the Strait of Hormuz blockade continues until the attacks stop. Those are two realities colliding. One reality says this is almost over. The other reality says we haven't even started. And the market is stuck between them like a driver slamming the gas and the brake at the same time. That doesn't create calm. That creates the kind of volatility that shreds portfolios. And here's what ING's global head of markets said, and I want you to really hear this. What will matter most is a reopening of the Strait of Hormuz and a restart of production across the Middle East. Until investors receive headlines on that score, we doubt the dollar is going to quickly hand back all the gains made over the last 2 weeks. Read that again. Until the strait reopens, the dollar stays elevated. And the dollar staying elevated is not a neutral event. A strong dollar crushes emerging markets. It makes dollar-denominated debt more expensive for countries that can barely afford it right now. It sucks capital out of developing economies and funnels it into U.S. assets. That's not a theory. That's a mechanism. And it's running right now in the background while everyone argues about whether Trump's comments mean the war is winding down. Now let's talk about the thing that should have gone up, but didn't. Gold. Gold dropped nearly 1% in a single session. And if you're sitting there thinking, wait, there's a war, there's inflation, there's chaos. Why would gold go down? Congratulations, you just asked the right question. Because the answer reveals something most people never learn until they've been burned. Gold didn't drop because the crisis got better. Gold dropped because the dollar got stronger and because Fed officials came out and said inflation is still too high to cut rates. Cleveland Fed President Beth Hammack said it directly. Inflation remains too elevated to justify immediate easing. That's the Fed telling the market don't expect relief. And when rate cut expectations get pulled off the table, gold takes a hit because gold pays no yield. When rates stay high, Holding gold costs you more relative to holding bonds. So gold drops. Not because the world got safer, because the cost of holding safety went up. Think about that. The crisis is getting worse, but the instrument people run to in a crisis is getting punished because the crisis itself is making rate cuts less likely. That's not normal. That's a trap. And it's the same trap that's about to hit your mortgage, your car loan, and your credit card bill. Now, I want to be careful here because this is where the story gets genuinely frightening, and I don't say that to be dramatic. I say it because the data supports it. Let me walk you through the word nobody wanted to hear this year. Stagflation. Stagflation is when you get the worst of both worlds at the same time. Prices going up and the economy slowing down. Normally those two things don't happen together. When the economy slows, demand drops and prices cool off. When prices rise, it's usually because demand is hot and the economy is growing. But when you get an external shock, like a war that shuts down 20% of the world's oil supply and a third of global fertilizer trade, you get price spikes that have nothing to do with demand. They're supply-driven. And supply-driven inflation is the one type the Federal Reserve cannot fix with interest rates without breaking something else. Because if the Fed raises rates to fight inflation, it crushes an already weakening economy. And if the Fed cuts rates to support the economy, it lets inflation run hotter. That's the trap. And the bond market just told you it sees the trap coming. Treasury yields posted their largest weekly jump since April 2025. The 10-year rose nearly 20 basis points in a single week to 4.14%. The 2-year climbed to 3.56. Those moves are not small. Those moves are the bond market repricing everything. Repricing how long rates stay high. Repricing how much damage this war does to the inflation trajectory. Repricing the probability that the Fed is stuck doing nothing while the economy deteriorates underneath it. And when bonds move like that, mortgages move. Credit moves. Corporate borrowing costs move. The entire architecture of how money flows through the economy shifts. And it shifts against you if you're a borrower. Now let me show you how far the damage has already spread because this is where most coverage stops at the gas pump and misses the earthquake underneath. The S&P 500 fell 2% last week. And I know 2% doesn't sound catastrophic. But look beneath the surface. Small cap stocks dropped 3.8%. Mid caps dropped 4.6%. Those are the companies that employ your neighbors, fund your local economy, and don't have billions in cash reserves to ride out a crisis. And internationally, it was a bloodbath. The MSCI International Developed Markets Index fell 6.7%. Emerging markets fell 6.8%. That is the worst weekly performance in nearly a year. And the reason is brutally simple. Europe and Asia depend on the oil and gas that flows through the Strait of Hormuz. When that strait closes, their energy costs explode. When their energy costs explode, their factories slow down. When their factories slow down, their currencies weaken, their stock markets crater, and capital flees to the United States, which pushes the dollar higher, which makes their dollar-denominated debts more expensive, which weakens them further. It's a doom loop, and it's already spinning. Now here's where I need you to pay very close attention, because this week is loaded with data that could either confirm the nightmare or give markets a reason to breathe. Wednesday, we get the Consumer Price Index for February. This is the most important inflation reading in months because it lands less than a week before the Federal Reserve's next policy meeting. Economists expect headline CPI to rise 0.3% month over month. But here's the thing. That estimate was built before the full impact of the Strait of Hormuz closure hit energy markets. If CPI comes in hot, if it comes in above expectations, the Fed's hands are tied. No rate cut, possibly even talk of a rate hike. And the market is not priced for that. Friday, we get the Personal Consumption Expenditures Report, the Fed's preferred inflation gauge. If core PCE shows inflation still stuck well above 2%, it doesn't just delay rate cuts. It kills the entire narrative that the economy was gently gliding toward a soft landing. That narrative is already on life support. These reports could pull the plug. And also on Friday, the University of Michigan Consumer Sentiment Survey drops. Last reading was 56.2, already low. If geopolitical chaos and rising gas prices push that number lower, you're watching consumer confidence crack in real time heading into an election year. That matters. That matters because consumer spending is 70% of the U.S. economy. When confidence breaks, spending follows. When spending follows, jobs follow. And that brings me to the part of this story that is getting criminally underreported. The labor market is not okay. Non-farm payrolls just posted a largely negative print. January retail sales declined for the first time in 3 months. The 3-month average for total non-farm payroll is 6,000 jobs. 6,000. The 6-month average is negative 1,000. The 9-month average is negative 4,000. Let me say that differently. Over the past 9 months, the U.S. economy has on average been losing jobs, not gaining them. And the one sector that had been carrying all the weight, education and health services, just reported a loss of 34,000 jobs due in part to a major strike. When your only engine stalls, you don't have a slow economy. You have a vulnerable economy. And a vulnerable economy getting hit by an energy shock is not a recession warning. It's a recession invitation. Now I want to give you something practical because the data fire hose means nothing if you don't have a framework. And let me be crystal clear. I'm not a financial advisor. I don't give financial advice. What I give you is a lens. So here are 3 things to track this week that will tell you more than any headline. 1. Wednesday's CPI number. If it comes in at or above 0.4% month over month, the stagflation conversation goes from whisper to scream. 2. The dollar index. If it stays above 99, even as hope headlines circulate, the market is telling you it doesn't actually believe the war is ending. 3. Watch the spread between the 2-year and 10-year Treasury yield. If that spread keeps widening with both yields rising, the bond market is pricing in sustained inflation with no growth to offset it. That's the stagflation signal in its purest form. When all 3 line up, the picture gets very clear and very uncomfortable. Now let me ask you something, and I want you to answer in the comments. When you see the dollar stall on peace hopes, but Iran says the blockade continues, do you think this war is ending soon, or do you think we're being set up for a much longer economic disruption? Because your instinct here matters more than any model. And here's another question. If Wednesday's CPI comes in hot, what do you think the Fed does at its next meeting? Hold rates and pray? Or signal that hikes are back on the table? Drop your answer below. I read every comment, and I want to see how this community is reading the situation. Now I promised you a warning, so here it is. The one mistake that destroys people during stagflationary shocks is assuming that what worked last year will work this year. Last year you could hold growth stocks and ride momentum. Last year you could count on rate cuts coming to bail out your mortgage renewal. Last year you could assume inflation was yesterday's problem. None of those assumptions are safe right now. And the people who get hurt worst are the ones who freeze, who refuse to update their model because the old model felt comfortable. Comfort is expensive in a market like this, and the biggest players know that. When you freeze, they move. When you panic sell, they buy. When you chase yesterday's trade, they're already positioned for tomorrow's reality. That's not a conspiracy. That's how capital works. It flows from the reactive to the prepared. And right now the gap between those 2 groups is widening every single day. So watch the data this week. Watch the CPI. Watch the Fed's language. Watch the bond market. Watch the straight. And most importantly, watch your own behavior. Because this isn't just an economic stress test. It's a psychological one. The market is testing whether you can hold your framework when every headline is designed to make you emotional. If you can stay disciplined through this noise, you put yourself in the tiny percentage of people who come out of this period stronger, not weaker. All right, I want to hear from you. Do you think we're heading into full stagflation, or do you think the war ends fast enough to avoid it? And if you've made any moves to prepare your finances for what's coming, share what you did in the comments. Let's build a thread of real strategies from real people. Subscribe if you haven't. Join the membership if you want the deeper layer. And I'll see you in the next one.